The first quarter is almost over, and the major indexes look like they've gone basically nowhere in the first quarter. So should investors be doing something with their portfolios? Should they change them? Good Haven Capital Management's Larry Pitowski has some answers, and he joins us now. Thank you for being here,
Simon,
sir.
thank you for having me.
This is your debut on the show. I'm sure you will not disappoint. You've seen the markets move sideways. Is there a reason for that? Is that just they're too expensive on an earnings basis now?
You know, Simon, at Good Haven, we are primarily risk-averse stock pickers, looking for undervalued companies where we think we have a lot of upside and not a lot of downside. The indexes to us have looked expensive for a while, and that's why we think it's even more important to be diligent and look for the areas that are unpopular and out of favor.
So unpopular, and this goes back to Warren Buffett's thing, and also the Rothschild's idea of the 19th century. When people are scared and there's blood in the streets, then you go in there, and you found some areas that are really interesting, and people are going to be kind of shocked by it because they're so out of favor and no one wants to touch them, right? Basically,
we've outdone ourselves. We've got a couple of sectors that are truly out of favor.
Let's quickly go with the oil one first, because the oil has been sort of a roller coaster ride downwards. What are you picking in the oil sector, and why?
You know, what attracts us to any investment is that if we think we're getting a bargain, we don't think we have much downside, we have a lot of upside. Energy has been so out of favor, you have to look there. But we think it's important to be very selective. We found one particular company, which is WPX Energy, which has a great new CEO. It has assets that we think are worth much more than the stock price, even if commodity prices never recover. 75% of the assets are in natural gas. Management is doing all the right things. They bought stock for themselves all the way down from in the 20s down to just a couple of days ago. So we think we're set up very well, and they've got a big pile of cash.
And you own it as well.
Absolutely.
To be clear, that now you're also looking at a gold company, and gold companies they make oil stocks look
That's
stable.
Right. That's right.
So which one did you pick?
Which puts a smile on our face when we find things that are so out of favor. It really does. We've picked Barrick Gold. Now, Barrick has an interesting history. It had been a low-cost operator, a well-run company, but they really wandered off the reservation, and the savior to return the company to its former glory is John Thornton, former president of Goldman Sachs. Took over about a year ago. He's the chairman of the board, but a very active chairman of the board, and he's slimming them down, cutting costs, realigning management with the owners, and we like everything that he's doing in the business. Okay,
and and you own that one as well. And I should point out that these gold companies, even the big ones, are relatively small compared to the rest of the investing universe. People are looking at central banks and what they're doing all over the world. You know, you look at Japan, you look at Europe, right. You look at the US. Broadly speaking, if you're a small investor, as a lot of us are, what should you be doing with your portfolio now if you don't want to stock pick? Now, we realize you're a professional stock picker.
Well, I think there's a couple of important things people should always be doing. One, I don't think people should be levered. Two,
that means they shouldn't borrow money.
They shouldn't borrow. You shouldn't borrow a lot. Two,
cash only.
You should always have some liquidity and some cash around to try and be opportunistic when markets get really out of sorts. And three, you should come up with some sensible long-term investment strategy and just continue doing that over time and not get shaken out by the volatility of the market, and look at the market downside as opportunities for you.
So broadly speaking, then, would that be for someone who was in their 40s, would you say 60% stocks, 40% bonds and real estate and that sort of thing? Is that more or less right?
Well, that sounds fine. Of course, it depends on the particular situation, but it doesn't sound like a bad place to start as an allocation.
Okay, great advice. Larry Pitowski, thank you very much.
Appreciate
your